Welcome to Alpha Recap, your quick, sector-by-sector market wrap. We recorded this after the close, and markets were closed on President's Day, but there was still a lot of news moving individual sectors. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to unpack, and a clear pattern jumped out. AI, digital commerce, and project catalysts grabbed the headlines, while crypto felt the heat.
Yeah, absolutely. To kick off, quick headline sweep. SiteOne reported a 120% jump in online sales. Apple moved more video into podcasts. There was a $335 million startup raise. And Blackstone-backed NISA was reported to be targeting up to about $1.2 billion for India AI compute.
Right. And at the same time, Bitcoin drifted into what looked like a 5-month losing streak, and crypto funds posted a fourth straight week of outflows. It was a story of concentrated winners and broad sentiment pain. So, what really stands out here is that AI and digital monetization were not abstract talking points. They translated into real capital flows and product moves that will show up in earnings and CapEx.
Let's walk through that. First, the outperformance bucket: technology, consumer, and materials. Tech picked up steam because of the NISA, the $335 million raise and product roadmaps from big players. Consumer was boosted by SiteOne and OpenAI expanding in-chat checkout. Materials saw permit wins, tailings deals, and project funding, all actionable catalysts.
Yeah, and that combination matters. AI creates durable CapEx demand for data centers, chips, and specialty materials. Also, retail media and in-chat checkout turn attention directly into revenue, which is huge for margins.
Quick reality check. While those pockets lit up, crypto, healthcare, and some energy names were more mixed or under pressure. Crypto flows were especially notable. There was a lot of sentiment movement there.
Totally. And to be clear, this was not just retail price action. The outflows were systemic, which compresses risk appetite for speculative names and can ripple into related public companies and ETFs.
Short reaction.
Hold on, say that again?
When you step back and look at this, flows mattered more than fundamentals in crypto today. But there was a second track. Institutional activity into DeFi and tokenized real-world assets kept a smaller set of opportunities alive.
Right. Two-track market. Retail-led speculative demand was weak, while regulated, yield-bearing structures got attention from pros.
Let's dig into the most significant moves. First, crypto. Bitcoin headed toward that 5-month losing streak. Crypto funds had a fourth consecutive week of outflows, and investor fear metrics hit multi-month lows.
Why it mattered. Outflows and fear compress risk appetite. Investors with lower tolerance probably reduced broad crypto exposure, but the tactical angle was clear. Regulated, tokenized real-world assets and institutionally focused DeFi setups were getting private interest.
Short reaction.
Yeah, that tracks.
Second big move: AI and infrastructure capital formation. NASA looking to raise up to about $1.2 billion for India compute. And that $335 million startup raise, those are not small signals.
The number that really caught our eye was NISA's size. These allocations forced demand for data center real estate, power and cooling, semiconductors, and mining-related materials.
And that India angle matters. Geographic diversification of build-outs helps equipment and material suppliers globally. Investors should favor firms tied directly to hyperscale build-outs and infrastructure services.
Agree. Data center real estate, power infrastructure suppliers, and GPU accelerator manufacturers were the obvious beneficiaries in our read.
Third, consumer, retail media, and commerce acceleration. SiteOne's 120% online sales jump and OpenAI's in-chat checkout expansion are concrete examples of turning attention into sales.
Those moves improve conversion, which lifts margins and add inventory value. So ad tech, payments, and retailers with logistics muscle were in the sweet spot.
And materials. Project wins were tangible. Think about the roughly 2.9 million ounces silver tailings deal. Sandvik's roughly $132 million pledge to a salt project, and Barrick's 10-year permit renewal in Mali.
Those are classic de-risking moves. Permit renewals and financing shorten the timeline to production and cash flow, and in a cyclical sector that can outperform sentiment-driven peers. Quick three-word reaction.
Not what anyone expected.
Moving on. Energy was mixed. Long-duration storage and EV progress were constructive, but rising solar input costs and pipeline disruptions were headwinds.
That created dispersion. Integrated developers and companies with firm offtakes won, while pure project developers without procurement advantages struggled.
And utilities were still in transition mode. EV adoption and distributed resources supported load narratives, but gas plant additions and water planning issues added complexity.
Okay, let's pause and explain one cross-sector concept in simple terms. Retail media and in-chat checkout. Essentially, retailers are selling ad space built on their own shopper data. And when you can take a conversation and convert it directly into a sale inside that chat, you close the loop from ad to purchase. That raises conversion and makes advertising more valuable.
Exactly. It's about turning attention into measurable, attributable revenue. For investors, companies that own the checkout and the data win.
Sector by sector, quick hits on what to watch. Technology. Follow data center capacity, GPU demand, and Apple's content monetization cadence.
Consumer. Watch online sales penetration and retail media CPMs. Materials. Monitor CapEx schedules and permit news. Communications. Cable CapEx cycles and branded content measurement standards matter.
Utilities. Keep an eye on rate case outcomes and storage procurement. Real estate. Mortgage origination execution and cap rate moves for industrial and multifamily. Energy. Project-level offtakes and solar input cost trends.
Finance. Corporate actions like dividend hikes can move stock-level returns. Healthcare. AI and interoperability help, but payer-provider stress is a real swing factor. Crypto. Watch weekly fund flows and monthly Bitcoin closes.
Let's talk through actionable investor moves. First, overweight AI infrastructure and selected tech exposure. Why? Sustained capital formation for compute is multi-year and supports hardware and power demand.
Right. Prefer industrial and data center real estate, power and cooling suppliers, and parts of the GPU supply chain, over momentum-only software names.
2. Favor consumer names that monetize data and convert traffic to sales. Tilt to retailers with first-party shopper data, ad tech partners and payments processors that enable in-chat commerce.
3. Be selective in materials. Focus on project-backed names. Permit wins and financing shorten time to cash flow, but you need to check jurisdictional risk.
4. Take a tactical stance in crypto. Avoid broad market leverage. Consider regulated, yield-bearing, tokenized real-world assets or DeFi protocols with institutional backing.
5. Position for the energy transition but hedge supply chain risk. Long-duration storage is a high-conviction area if you pick companies with procurement advantages or firm offtake contracts.
6. Treat healthcare as a stock picker's market. AI and new research create winners, but reimbursement and regulatory risks make idiosyncratic moves necessary.
Let's call out the main risk factors to watch. Macro surprises, like a surprise move in rates, supply chain and input cost inflation, geopolitical and permitting risk in materials, crypto regulation and execution risk in AI projects.
And remember, the market was not broadly risk-on or risk-off. It was selective. The premium went to investors who paired theme conviction, like AI and grid modernization, with careful selection on execution and balance sheets.
Honestly, I was a bit surprised by how much project-level news outpaced broad macro narratives today. Deals and permits moved prices more than big macro headlines.
Yeah, little concrete wins went a long way.
So, final takeaways. 1. Back AI and infrastructure themes where capital formation is real. 2. Favor retailers and tech names that convert attention into sales and ad dollars. 3. Be selective in materials and energy, focusing on confirmed projects and integrated operators. 4. Treat crypto as tactical, not strategic, unless you're in regulated institutional formats.
Quick wrap. As markets were set to reopen on February 17th, the landscape looked bifurcated. Clear winners in AI, digital commerce, and project catalysts, and selective pain in crypto and parts of energy and healthcare.
For monitoring, watch February earnings commentary for retail and tech, weekly crypto flow prints and Bitcoin monthly closes, and permit or offtake announcements in materials and energy.
If you want to dig deeper, we built this rundown to help investors pick the pockets that actually have execution and cash flow paths. And remember, thematic conviction without execution checks is risky.
Final quick reaction.
Back the leaders, be picky.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.